Cash flow management is one of the most important parts of running a growing business. Many business owners focus a lot on sales, customers, and expansion, but they forget that a business can look busy and still struggle because of poor cash flow. A business may have many orders, loyal customers, and good profits on paper, yet still fail to pay rent, salaries, suppliers, taxes, or transport costs on time. This is why cash flow matters so much. It is the movement of money into and out of the business. When cash flow is healthy, a business can meet its daily needs, plan ahead, and grow with confidence. When cash flow is weak, even a promising business can face stress, debt, and missed opportunities. For growing businesses in Kenya, cash flow management is even more important because growth often comes with higher expenses before the extra income is fully received. A business may need to buy more stock, hire more workers, move to a larger shop, add delivery services, pay for marketing, or buy equipment. All these things need money first. At the same time, some customers may ask for time before they pay. A supermarket, school, office, or corporate client may take 30 days, 45 days, or even longer to settle an invoice. This means the business owner must keep operations moving while waiting for money that has already been earned but has not yet been received. That gap between making a sale and receiving the money is where many cash flow problems begin. It helps to understand the difference between profit and cash flow. Profit is what remains after a business subtracts its expenses from its revenue. Cash flow is the actual money entering and leaving the business. A business can make a sale today and record it as revenue, but if the customer will pay after 1 month, the business does not yet have that cash in hand. Meanwhile, the landlord, employees, transport providers, internet company, and suppliers still expect payment. So profit and cash flow are not the same thing. Profit tells you whether the business is making money in general. Cash flow tells you whether the business has enough money available right now and over the coming days and weeks. Imagine a growing cleaning supplies business in Nairobi that supplies offices, schools, and apartment buildings. The business receives a large order worth 300,000 Kenya shillings from a company and delivers the goods successfully. On paper, that looks like a strong month. However, the client will pay after 45 days. During those 45 days, the business still has to pay workers, fuel, rent, packaging, internet, and suppliers. If the owner does not have enough cash set aside or does not plan properly, that one large order can create pressure instead of comfort. This is one of the biggest surprises for many business owners. Growth can increase stress if the business grows faster than its cash reserves. Cash flow management means planning, tracking, and controlling all the money that comes in and goes out of the business. It means knowing how much cash is available today, how much is expected next week, how much must be paid at the end of the month, and what problems may appear before they become emergencies. Good cash flow management is not only about cutting costs, it is also about timing. It is about making sure money comes in quickly enough and goes out carefully enough for the business to stay stable. Growing businesses often face several cash flow challenges at the same time. One common problem is late customer payments. Some customers delay paying because they are disorganized, while others simply take longer than agreed. When a business depends on those payments to keep operating, delays can cause serious pressure. Another challenge is overstocking. Many business owners buy too much stock because they fear running out or because they are attracted by a bulk discount. But if that stock moves slowly, a lot of money stays tied up on shelves instead of being available for salaries, rent, or marketing. Another challenge is rising overhead costs. As a business grows, it may add employees, subscriptions, delivery services, and office expenses faster than it increases its collections. A business can slowly build a cost structure that looks manageable during good months, but becomes heavy when customers delay paying. Taxes are another major issue. Some business owners treat tax money as if it belongs to the business. For example, if a business collects value-added tax from customers, that money should not be spent on daily operations as if it were free cash. The same applies to payroll deductions and other statutory payments. If tax money is mixed with operating money and used carelessly, the business may find itself unable to meet tax obligations when deadlines arrive. This creates stress, penalties, and even more pressure on cash flow. One of the smartest ways to manage cash flow is to prepare a cash flow forecast. A cash flow forecast is a simple plan that shows how much money is expected to come into the business and how much money is expected to go out over a certain period. For a growing business, a rolling 13-week forecast is very useful. This means the business looks ahead for the next 13 weeks and updates the plan every week. The owner or manager lists expected customer payments, cash sales, deposits, loan receipts, and any other money expected to come in. Then they list salaries, rent, stock purchases, fuel, transport, taxes, software, loan repayments, and other expected payments going out. The goal is to see future pressure before it arrives. A good forecast does not need to be complicated. It can start as a spreadsheet with columns for each week and rows for each major inflow and outflow. The first line can show the opening cash balance. Then the business adds all expected incoming cash for that week and subtracts all expected outgoing cash. The result becomes the closing balance for that week and the opening balance for the next week. By doing this, a business owner can see if there is a week where the balance may become too low or negative. If a problem appears in week 4, there is still time in week 1 to do something about it. That is the real value of forecasting. It gives a business time to act. For example, let us say a business starts the month with 400,000 Kenya shillings in available cash. It expects to receive 1,200,000 Kenya shillings from customers during the month. At first glance, that sounds strong, but then the owner lists expected payments. Stock purchases will cost 700,000 Kenya shillings. Salaries will be 220,000 Kenya shillings. Rent and utilities will be 90,000 Kenya shillings. Fuel and transport will be 80,000 Kenya shillings. Taxes and statutory obligations will be 140,000 Kenya shillings. Loan repayment will be 60,000 Kenya shillings. Suddenly, the business can see that even though sales are healthy, the timing of these payments may create a cash shortage. If supplier payments fall early in the month and customer payments come late, the business could struggle. This is why a business should never rely only on the total monthly figures. The weekly timing matters just as much. Another important idea in cash flow management is working capital. Working capital is the money tied up in the daily running of the business. In simple terms, it includes stock, money owed by customers, and money owed to suppliers. If a business has too much money locked in stock and unpaid invoices, but not enough supplier credit or cash reserves, it may become cash-strained even while growing. Working capital is one of the main reasons businesses struggle during expansion. A business buys more stock to meet demand, gives customers more credit to win contracts, and then waits too long to get the cash back. Think of the working capital cycle like this. First, the business uses cash to buy stock or raw materials. Then it sells the stock or uses the materials to deliver a service. After that, it sends an invoice and waits for the customer to pay. Only after the payment arrives does the cash return to the business. The longer this cycle takes, the more pressure there is on cash flow. If stock sits for too long, or if customers take too long to pay, the business needs more cash to keep moving. That is why smart business owners watch their stock levels, follow up on invoices, and negotiate supplier terms carefully. A growing business can improve cash flow in many practical ways. One of the easiest is to invoice quickly. Some businesses deliver goods or finish work, then take days or even weeks before sending the invoice. That delay slows down payment and creates unnecessary pressure. Invoices should be sent immediately, and they should be accurate. A missing purchase order number, wrong amount, or incorrect customer name can cause delays. The invoice should clearly show the due date, payment details, and contact information. It is also wise to tighten the credit policy. Not every customer should be given the same payment terms. Some customers are reliable and may deserve 30 days. Others are new, risky, or known for late payment, and they may need to pay in advance or at least give a deposit. A business that gives too much credit too easily may increase sales, but damage its own cash flow. A balanced credit policy protects the business while still allowing growth. Following up on receivables is another major part of cash flow management. Businesses should not wait silently and hope customers will remember to pay. A simple process can make a big difference. After sending the invoice, the business can confirm that it was received. A few days before the due date, a reminder can be sent. On the due date, the business can follow up again if payment has not arrived. If the customer delays, the business can call and ask for a clear payment date. The point is to be polite but firm. Cash flow improves when collections are treated as a routine part of the business, not as an awkward afterthought. For service businesses, project businesses, and custom work, deposits and milestone payments are very helpful. A printing business, construction firm, event planner, digital agency, or consultant should not always fund the entire project using its own money. Instead, the business can request a deposit before work starts and collect the balance in stages. For example, a printing business might ask for 50% before printing, and 50% before delivery. A web designer might ask for 40% before work begins, 30% halfway through the project, and 30% on completion. These payment structures reduce cash pressure and protect the business from carrying all the risk. Stock control is also essential. Too much stock traps money. Too little stock may lead to lost sales. The goal is balance. A growing business should know which products move quickly, which ones move slowly, and which ones bring the best margins. Dead stock should not be ignored. If items have sat for months without moving, it may be better to discount them and turn them back into cash rather than let them keep taking up space and money. Buying smaller quantities more often may sometimes be better than making one huge purchase just because the price per unit looks attractive. Supplier relationships can either help or hurt cash flow. Good supplier terms can ease pressure significantly. If a business can pay suppliers after 30 days instead of immediately, it gets more time to sell stock and collect from customers before cash leaves the business. This does not mean delaying payment carelessly. It means building trust and negotiating terms that match the business cycle. Reliable businesses often get better terms over time if they communicate well and pay consistently. A supplier who trusts your business may be willing to split payments, extend credit, or hold prices for a period. These small changes can improve cash flow in a big way. Business owners should also separate tax money from normal operating money. This is a very practical discipline. If a business knows it will owe taxes or statutory payments at the end of the month, it should set aside part of that money as sales are collected. Waiting until the due date to think about taxes is risky. A simple reserve account can help. Even if a separate account is not possible, the business can still treat that amount as unavailable and avoid spending it on stock, personal needs, or non-urgent expenses. Another strong habit is building a cash buffer. A cash buffer is money kept aside to help the business survive unexpected delays or emergencies. Every growing business should aim to have at least some reserve for difficult weeks. The ideal amount depends on the type of business, but having enough to cover 1 to 3 months of essential expenses can provide stability. If a business needs 600,000 Kenya shillings each month for rent, salaries, transport, and utilities, then a buffer of at least 600,000 Kenya shillings can make a huge difference during a slow period or when a major customer delays payment. A business owner should also be careful with personal withdrawals. In many small and growing businesses, the owner uses business money for household needs whenever the need arises. While this may feel normal, it can destroy cash flow visibility. The business account becomes harder to understand, and important payments may be missed. It is better for the owner to set a planned salary or monthly draw. This helps separate business finances from personal finances and makes forecasting more accurate. Pricing is another area that affects cash flow more than many people realize. Sometimes a business has a cash flow problem because it is underpricing its products or services. Costs may have gone up, but prices stayed the same. Fuel, packaging, salaries, internet, rent, and supplier costs may all rise over time. If the business does not review prices and margins, it may continue making sales that do not generate enough cash to support growth. A business should know which products or services bring strong margins and which ones are eating into cash. Sometimes the solution is not to sell more, but to sell better. Cost control also matters. Growing businesses often collect many small recurring expenses without noticing how heavy they become. A new software subscription here, an extra delivery rider there, more airtime, more fuel, more packaging, more online tools, and soon the monthly spending becomes much higher than expected. It helps to review all expenses regularly and ask whether each one is truly necessary. Some costs support revenue directly and are worth keeping. Others are useful but can be negotiated. Others add little value and should be cut. This kind of review protects cash flow before pressure becomes severe. A weekly cash review routine can change the health of a business. Even a small business can benefit from setting aside time every week to look at cash. During that review, the owner or manager can check bank balances, business mobile money balances, expected customer payments, overdue invoices, upcoming salaries, rent, tax deadlines, supplier obligations, and stock needs. The forecast can then be updated with actual payments received and new expected expenses. If a cash gap is visible, the business can respond early by following up customers, delaying non-essential spending, reducing stock purchases, or negotiating payment timing with suppliers. There are also warning signs that show a business may be heading into a cash flow problem. One sign is when the business regularly delays paying suppliers just to survive the month. Another sign is when taxes become stressful because the money was already used elsewhere. Another sign is when the owner constantly moves money between personal and business accounts to plug holes. It is also a warning sign when sales are rising, but the bank balance is not improving, or when the business cannot clearly say when its biggest invoices will be paid. If inventory keeps increasing but cash keeps tightening, that is another red flag. These signs should not be ignored. Different types of businesses face different cash flow pressures. A retail or wholesale business often struggles most with stock levels and supplier payments. A service business may struggle more with late-paying clients and project delays. A construction or event business may face large upfront costs before the final payment arrives. An e-commerce business may need to manage advertising costs, delivery costs, returns, and stock replacement at the same time. Even though the details differ, the core lesson remains the same. The business must know when money is coming in, when it is going out, and what risks could interrupt that flow. Technology can help with cash flow management, especially as the business grows. Accounting software, inventory systems, invoicing tools, and simple dashboards can make it easier to track what is happening. A business does not need the most expensive system. What matters is having accurate records and timely information. The owner should be able to see who owes the business money, which bills are due, what stock is available, and what the likely cash position will be in the coming weeks. Good records improve decisions. Poor records hide problems until it is too late. Cash flow management also requires honesty. Business owners sometimes create forecasts based on hope instead of evidence. They assume a client will pay this week because they need the money to come in, not because there is a real commitment from the client. They ignore possible delays or underestimate upcoming costs. A good forecast should be realistic. If a customer usually pays 10 days late, the forecast should reflect that. If stock costs rise during certain seasons, the forecast should reflect that too. Honest planning is more useful than optimistic planning. It is also helpful to think in scenarios. What if your biggest customer pays 1 month late? What if sales drop by 20% next month? What if fuel prices rise and transport costs jump? What if you need to replace a machine suddenly? These questions may feel uncomfortable, but they help the business prepare. Scenario planning does not mean expecting the worst all the time. It means understanding the business well enough to respond calmly when something changes. A healthy business does not only chase growth, it also protects stability. This is where discipline becomes more important than excitement. A business owner may be tempted to open a new branch, buy more stock, hire quickly, or invest in a major office upgrade because the business seems to be doing well. But if cash flow is not ready, those decisions can create strain. Growth should be supported by planning. Before taking on a big expense, the business should ask, will we still have enough cash to run comfortably over the next few months? If the answer is uncertain, it may be better to slow down, strengthen collections, build reserves, or spread the investment over time. For Kenyan businesses, cash flow management is especially important because many small and medium businesses operate in environments where payment delays, cost increases, and seasonal changes are common. School suppliers may wait for institutions to release funds. Construction businesses may wait for approvals. Retailers may face sudden supplier price changes. Farmers and agribusinesses may deal with weather patterns and seasonal demand. Transport costs can rise unexpectedly. All these realities make cash flow planning essential rather than optional. At its heart, cash flow management is about keeping the business alive and strong enough to keep growing. It is about making sure success on paper becomes stability in real life. A business with strong cash flow can pay people on time, buy stock confidently, handle emergencies, take advantage of new opportunities, and sleep better at night. A business with weak cash flow is always under pressure, even when sales are coming in. The good news is that cash flow can be improved. It is not only about having more money. It is about managing timing, building habits, and making smart decisions. Invoice quickly, follow up customers consistently, control stock carefully, negotiate supplier terms, set aside tax money, review expenses often, build a cash reserve, separate business and personal spending, forecast every week, be realistic about risks. These habits may sound simple, but together they create a powerful system. In the end, many growing businesses do not fail because the owners lack energy, talent, or customers. They fail because cash leaves too early, arrives too late, or is not planned properly. That is why cash flow management deserves attention from the very beginning, and even more as the business grows. Profit is important, but cash keeps the doors open. Cash pays the team, restocks the shelves, fuels the delivery vehicle, covers the rent, and gives the business room to breathe. When a business learns to manage cash flow well, growth becomes less stressful, decisions become clearer, and the future becomes much easier to build.